The broadcast is now starting. All attendees are in listen-only mode.
Hello, it's Kevin Prince again, and welcome back one more time to the Market Insights webinar. So pleased you took the time to join us today again. Really look forward to today's topic. We're going to spend some time around the considerations of the U.S. election and position around that. Just want to give you some insights in regards towards the market itself. And I really like also all those people that have taken the time and effort and send us in the questions, because those questions continue to drive the content of this webinar. And thank you for those who've done that. And I look forward to getting more questions in the future from everybody out there. And one special request I can ask for everybody too is, if you like this webinar on a regular basis, just tell a friend, right? Because we really appreciate the opportunity to develop this content and put it together for the broader audience out there. So with that, let's get started. So with our focus, I should mention disclaimer, we always mention this, bear with me. Really what our goal today is not specific advice. And even if you have specific recommendations, specific ETFs on the page, that's not a recommendation. It's just some insights and some ideas out there across the board. And if you're looking for advice to the overall market, we do encourage you to seek out professional advice around there, talk to the experts in the marketplace, review your own portfolio across the board. So with that, let's get started in here. I'm going to introduce my guest today. My guest today is Chris Heeks, one of the portfolio managers at BMO ETFs. Thanks, Chris, for joining us.
Thanks, Kevin. Pleasure to be here.
And like in previous webinars, we always like to start off with a tool. So I'm going to highlight an interesting tool, and it's kind of relevant for today's conversation across the board. So first and foremost, equityclock.com is the website. On equityclock.com, you can certainly look at the seasonality of various investments, and they have a lot of information on there. Dig at it. It's very interesting. But specifically for this discussion, they also have taken a look at the seasonality. And bear with me, when I'm saying seasonality is what the regular performance is of an investment is during a certain month. And what they've looked at is what's the seasonality of the election year itself in the United States. A lot of people talk about the election year, so what effectively they looked at is what's the performance relative to the election year. So if you're looking for some insights on that, take a look at equityclock.com. And then when you're inside there, because there's so much information, just search for election. And there's actually about 4 or 5 different, 4 different slides about different periods in around the election, beforehand, afterwards, all that's there for you too. And this is a snapshot of one heading into the election on average. So with that, let's get into the actual topic itself. Chris, I mean, I know you've been following the election. It's pretty hard not to follow the election right now in the States. It's pretty much headline news all the time. Certainly seeing some stats coming in around Biden, and certainly seeing the debates more recently. Chris, give us some background on what you're seeing in the polling and those aspects of the marketplace.
Well, thanks, Kevin, and yeah, thanks to the audience for giving us the opportunity to speak. You know, I think something was quite interesting is usually kind of a bad month, but it has proven to be a good month to buy equities. So you saw that equities usually go up there, and that's something to keep in mind. I think, you know, there's a lot of noise with the election. I think unlike, you know, any that I can remember in terms of the U.S. election. But remember that, you know, risk and uncertainty can create opportunities. And, you know, I think as we go through, I think we're going to take a little bit of a bigger picture look. You know, we're going to look at a few different scenarios, of course, whether Biden or Trump get in. But I think overall, what we're going to find is we're fairly constructive over equities. You know, we think as we're navigating COVID, you know, we don't know what life is going to be like in 3 months, but we feel pretty good that we're going to navigate this over that 12 to 18 month range. And really, as an equity investor, you're investing for longer term. You're not, we're not trying to time the market in any of these strategies. So let's take a look at where we're at. You can see on the slide here, Biden has opened up quite a lead. He's now the consensus favorite to take the popular vote, certainly. If not the election, he's certainly the favorite right now. Trump is hanging in there. You know, there's a couple areas. You know, certainly has a strong base of support. I think people in the past have you know, not paid attention to them, perhaps at their at their, to their neglect. He's surprised once before, so we will not count him out, but Biden certainly looks like the favorite right now. Now, in terms of the states, Kevin, do you want to?
Yeah, so let's advance to the next slide. Yeah, that's the key thing here. Take a look at the state by state aspect too, if you can, give us insight. Yeah.
Well, we remember, Trump. Look at these states on the left here. Michigan, Wisconsin, Pennsylvania. These were states that Trump won. He won narrowly in the last election, but very much historically were Democratic states. So the Rust Belt, as it's known. So you can see here, it's a little interesting. The Rust Belt looks like it's going Democratic. One of the states that people are watching the most is Florida. Florida does have a lot of electoral college votes, and we remember that each state gets a certain number of votes to count towards the total of the two contenders. It's not just a pure popular vote in the U.S. Florida is a close one. So Florida is one that is being watched closely. But again, you can see some of these states that Trump won narrowly going Democrat. So certainly that's that's the direction that we're moving right now, looking at a Democratic nomination for Biden.
So let's take also a look at the other aspect too, the Senate races too, because that's another big aspect, because it's not, of course, just the presidency that's going on, it is the Congress and the Senate being the one that's held by Republicans right now.
Yeah, it's a bit of a three-headed beast in the US. So if there's a piece of law, that piece of law goes through the Congress first, then it goes through the Senate, and then it's up to the president, who can choose to sign it into law or to veto it. So certainly three levels of government that all have a significant impact. I mean, we'll get Congress out of the way. Congress is not an interesting race. Congress is pretty much unanimously going to go Democrat. The Senate is a close one. The Senate is probably the closest one right now. It's leaning Democrat. You can see in this chart, it's pretty mixed, and the Republicans hold the Senate, but only by a couple seats. I believe it's 52-48, very, very close. So literally one or two races could make the Senate. So that's something we're watching, because obviously, having that, if the Republicans control the Senate, then they're able to, have much more of a say into what law gets passed through the system, even if it's a Democratic president.
Now, Chris, it used to be said that, a Democratic victory or Republican victory can have a certain aspect towards the market. And I've seen lots of challenges that back and forth, Democratic versus Republican, what's good for the market. Have you heard anything clear on a direction where it's better for the Republicans to hold it or Democrats to hold it, or is it still kind of back and forth? Depends upon depends upon the color you are, red or blue these days.
Yeah, I think the consensus is, a status quo for Trump. If we're Republicans to keep the Senate and Trump to keep the Oval Office, Trump has been known for deregulation. He's been known for his tax cuts. He I think would be happy to tell you where the direction of the S&P has gone. So I think, Trump is certainly, seen as a pro-business choice. Biden has, committed to raising corporate taxes. There's a certain amount of fear, but I think what the market's getting its head around really is he's also a very pro-stimulus choice. And one thing that's really buoyed the markets these last 6 months has been stimulus, record amounts of stimulus, much more so than 2008, and on both a monetary basis and a fiscal basis. And we expect both, whether it be Biden or Trump, that stimulus, those stimulus packages they'll still be coming. So, I think regardless, even with Biden and increasing corporate tax rates, we're still pretty constructive from a stimulus point of view. We're navigating COVID. I don't think he's as bad for the markets as you might think, at first kind of knee-jerk reactions with higher taxes. So
it's always good to look beyond the headline news. Thanks for that. Let's dive into some scenarios, actually, and give some people some background of, implications out there and just some considerations. Again, not specific advice, but just some considerations. Talk to us about, the Democratic suite. What are those implications where, the president now becomes Biden, the Senate becomes Democrat, and the House remains as a Democrat. So walk us through that and maybe some implications around that.
Yep, and I think this would be most likely outcome or most likely scenario, to have that, Biden as president, Democrats taking the Senate, and of course keeping the Congress as well. We mentioned that corporate taxes are going up, but overall, I see a sweep as, sweep is very productive, and the markets do like, governments having control and able, I think what we'll look at in a sec is, if you have the Senate Republican, but the president's Democrat, you're obviously going to have a lot more infighting in terms of negotiating packages, and we can see that right now where Trump is trying to negotiate a stimulus package, and guess what? It's not going so well with the Democrats, So certainly having a sweep would be great for the Democrats. They can pursue their agenda. I think they're going to be very focused on stimulus, still navigating COVID first and foremost. Certain areas that would be, focus areas. So in addition to general growth, they do have quite a green agenda. The Green New Deal was talked about at extensive length at the vice presidential debate this week. So certainly ESG, is something where it's pretty interesting, and you could feel good about an ESG investment, but I think from an pure investment point of view, offers an attractive proposal as well, where you can actually benefit with return premiums. As money goes to ESG, that would be beneficial. So certainly I could think a Democratic sweep is going to kind of check the box for equity growth, check the box for ESG, and of course on this slide we always want you to keep your fixed income, keep your asset allocation balanced, but certainly a couple boxes there that are checked as well. And then last but not least, infrastructure, of course. Infrastructure is going to be an all-weather trade. They're going to check the box for stimulus packages on infrastructure.
So let's take a look at some of those underneath the hood. Again, just some ideas, considerations out there. Make sure you take a look yourself underneath the hood and do your own due diligence, and how it fits into your own personal situation is always a key consideration, and definitely reach out to professionals for that too, as you need. But in this space, if you're looking at in the international space, you can look at more like the ZEA or XIN out there. Those are the MSCI EFI particular ETFs in the marketplace, and Vanguard has one too in that space. Each one of those give you those broad market exposures for international. Speaking about Chris's point, take a look at ESG or green aspect. There's been a lot of net new products in this space. Take a look at those solutions out there. They would give you market-like performance, but we give the additional ESG kind of flavor for the overall market. And last but not least, fixed income too, for that matter, is just another aspect for anybody's portfolio, good diversification. But again, just some ideas for you. Keep this in your own consideration and make sure it fits within your own personal needs. Chris, take us into what are the implications now if we have more of a divided Congress now? That's where your Senate maintains as Republican, but the presidency changes. So walk us through those thoughts.
Yeah, so this is, I think, actually the worst, would be the worst outcome for equities. Again, one thing the equity market enjoys is certainty. I think as humans, we enjoy certainty. That's one reason the equity markets give us a nice return over time, is because we have to deal with a certain amount of uncertainty. But I think this, this scenario, this is the most highly uncertain one. And with a divided government, much tougher for either party to pursue, its agenda. So I don't think this is I wouldn't say this is a negative outlook on equities. I would just say, our constructiveness might just take a notch down slightly just due to the higher uncertainty. So that's why we think, in an environment like this, look at low volatility. Low volatility is, always a great tool to get exposure to equities, but to do so, on a more defensive basis. Another strategy we like is quality ETFs. So focusing on stocks that are growing their return on equity, consistent earnings, staying with fundamentally sound companies, it's very strong as well. And last but not least, and I'm going a little bit off script, but the covered call strategy, again, when volatility is high, uncertainty is high, covered calls can give you an extra income stream to help buffer your returns in the market and give you kind of an additional 3, 4, 5% yield. Actually, in a volatile environment, covered calls, we can generate some really good income. It's not really a bad thing for that strategy. So that's something you could look at, like we have a ZWG, a global high dividend covered call. But again, blue chip dividend payers, staying with fundamentally sound, strong companies. And the covered call strategy gives you that ability to earn some extra income by monetizing the volatility. So that's another way to look to play it. But certainly, I think a little more defensive, a little more income oriented across the board.
And just some examples for everybody out there too. Again, make sure you do your own due diligence around this and look underneath the hood and factor how it's going to fit into your own personal portfolio. But you can certainly look at some ideas around low volatility in that aspect, or something that may produce a different, more of a complement, like a ZPay in the marketplace, not specifically focused on low volatility, but more of a complement. Financials, this is more US-based financials, just to highlight those ones. And then, of course, your overall balanced portfolio. Certainly those asset allocation solutions out there that have been coming to the market this year, and certainly been a good core holdings. We've talked about those in the past. Certainly another consideration for a diversified approach during these markets. Now, let's talk about the actual status quo. So let's say everything stays the way it is there, Chris. Thoughts in around that?
In descending order of likelihood, but as I said, never count Trump out. We saw what happened last time. So probably this is the least likely scenario. Maybe this is call it a 10, maybe 20% chance. But certainly Trump has been known for, deregulation. He's a pro-business, seen as a pro-business choice. And, he's been known for the tax cuts. And again, he's known for the stimulus that's been provided into markets to navigate through COVID. So the status quo is a pretty good, scenario for equities. He's known for his kind of tough stance on China. There's a little bit of rhetoric flowing back and forth that I think is perhaps maybe counterproductive at times. But overall, Trump wants to make a deal. He wants to grow the country. He wants to invest and see the country do well. So I think, despite all his many faults, he does have that in place. So I think equities is, this would be our most constructive. So we have broad beta, certainly defensive equities. We just want to highlight there's always room for defensive growth in the portfolio. Sticking with fundamentally sound companies, especially during this period of time, I think is important. But again, broad beta. And this is where we would say, the outlook where you could take a little bit more risk potentially could be associated with more return. So could be a good environment for high yield bonds, high yield being a riskier segment of fixed income, could be a good environment for small cap stocks as well. And small cap stocks usually give you a little extra return versus broad benchmark with a little help. But again, pretty constructive environment for equities across the board in this scenario.
And once again, we'll take a look at some of the ideas you can consider in your portfolios at tilt or so. And Chris, walk us through a little bit about the quality right now. And you said defensive equity, and you mentioned quality. Maybe we've brushed before. Maybe why quality in a growth market?
Well, that's the one thing that quality does is, it certainly gives you defensiveness. When the market's falling, these companies are earning, they're fundamentally sound, they're earning more income, they're earning it consistently. But it also, a quality company is a well-managed one. So the way we think of quality is really like this Warren Buffett style of investing, where he wants to own the best companies in the world. I personally, I think quality is always a good one to go with throughout the market cycle. But particularly, in an uncertain environment, I prefer to be in, higher quality investments overall. Right now with the uncertainty, and in knowing that you're participating in growth, your actually quality it has been outperforming the index for the last 2-3 years. So you certainly haven't sacrificed anything. But yeah, being fundamentally sound, I think, is really strong. And you can see as well, one thing quality has picked up on is technology stocks. And so you can see we're looking at the NASDAQ as another great exposure in this scenario. Certainly you want tech in your portfolio. Those technology companies are some of the highest quality companies in the world right now. I think Microsoft is now charging you an annual fee for your Microsoft Word and Excel. So they somehow figured out how to go from, you buy the software every 5 years to making you pay for it annually now. So I think it was pretty good for them, and the stock has certainly gone in that direction as well. So stick with high quality, I think is a good trade right now.
Thanks for that, Chris. And again, it's not individual recommendations. We encourage everybody to certainly do your own due diligence, make sure it fits with inside your own portfolio across the board, and then of course seek the professional help as you see fit, of course, across the board. Chris, now let's talk about it in another aspect, because we certainly talked about, there's an outcome, there's a decision being made. There's also, subtext going on in the various particular media out there that there could be a contested election. Walk us through that a little bit and maybe some thoughts around that in general.
Yeah, so it's interesting. The US has a mail-in voting scheme. Actually, Democrats are 4 times as likely as Republicans to do a mail-in vote, which is pretty interesting to me. It's a drastic difference. So there's a certain amount of voting that's already been done and mailed in, but there's a lot more to do. The mail-in voting could really extend out this cycle. It's even possible Trump could be declared the winner on election night, but then as votes continue to come in and be counted over the next few weeks, that could flip. That scenario is called a mirage victory for Trump. So again, what's going to happen in a contested election? It's going to be a lot of uncertainty. We did see it before with Al Gore and George W. Bush back in 2000. Equity markets sold off 10% in the kind of the 30 or so days that it was contested. Al Gore ended up conceding eventually after about a month. He did concede. One thing we're focused on right now, Kevin, is no one's conceding this election. This is a high stakes battle. No one is conceding, and the problem that it gives for investors is it's going to stretch out that uncertainty. So be prepared for a little bit of volatility. That's certainly one reason why I think quality can help mitigate some of that, and staying in fundamentally strong companies, sticking to your asset allocation. But certainly, keep an eye out for this scenario of a contested election. It could be a bumpy ride for a few weeks as it's navigated.
Yeah, I'm hoping for the market calm through all this. Absolutely. Thanks for that, Chris. And just keeping some context here, Chris is right. There could be a volatile market out there for a certain period of time. And if there's a volatile market, or if you're really want to engage and try to take advantage of different swings in the market out there across the board, let us give you a quick couple of trading tips just to factor in as you're maneuvering through the marketplace. And these are kind of relating towards ETFs right off the bat. Is that kind of want you to consider avoiding that open and close the marketplace, that first 15 minutes of the market or the last 15 minutes of the marketplace. And just understand that an ETF is a basket. And because it's a basket, we really need the pricing of the underlying to affirm the price of the basket. And that really helps it set the price of the ETF. So before that happens, it could be a little bit wider bid offer spread. And then the same thing for the end of the day, we have participants in the market called market makers. They kind of arbitrage the difference between the value of the basket and the value of the ETF. Those individuals, do they want to carry risk overnight? Possibly not. So, they would also look to widen the spreads at the end of the day. So really trading in the middle of the day or out of the open and the close is probably more efficient for a marketplace for you. One key thing, of course, all you think about there too is utilize limit orders when you're entering trades, and maybe even stop loss limit orders or combination orders out there too, because really that helps you identify the right price that you're going to attain in the marketplace. Key thing to do, not just stop orders, but stop loss limit orders like that too, for that matter. And then other ideas for you too around trading tips is trading when the market's open. Now this is really kind of one of those things you think about around international marketplaces, right? So, when their market is open and our market is open, that's going to be one of the more efficient parts of the marketplace, because the the basket can be offset by the underlying itself, right? So they can trade back and forth because an ETF is exchangeable for the underlying is exchangeable for the ETF, and that's really helps the participation and the valuation of the ETF in the middle of the day. So if you can, for example, European markets trade that in the morning. Sometimes you can't, emerging markets, I understand, but if you can, think about that. And I'd also say think about that not just for this upcoming U.S. election, but think about that when it comes to holidays too, when our market's open and other markets potentially closed. And of course, always be aware of the market volatility. During times of volatility, there could be wide bid offer spreads. Another good reason for you to enter those limit orders to ensure you get those best prices out there. So with that information in place, let's switch gears a little bit, Chris. Wouldn't mind diving into a couple of questions that came in from the audience here.
Okay, sounds good.
Yeah, perfect. So Chris, first and foremost, the questions coming in, building off our conversation last week, we talked about dividend ETFs and really dived into those pretty extensively. What they're really looking for here is what dividend ETFs, the top dividend paying ETFs of ours, and then really also want to dive into the S&P and NASDAQ. So let's break this in a couple of pieces. And I will let everybody know right off the bat that there's 34 ETFs in our own website that pay more than 4% across the board, right? So if you're looking for dividends, there's a bunch of choices out there. It really goes back to your individual needs and identifying which ones are right for you. If you're on the BMO ETF website, all you simply have to do is just BMOETFs.com, just scroll down, and actually right on that page, you scroll down, you can see the yields on those ETFs to the far right. And then just start to think about how you want to complement your portfolio with those across the board. Again, based upon your individual needs. Now, is there any cases where ETFs such as the S&P or the NASDAQ pay dividends? Let me answer that one in that what you tend to find is that different ETF providers do different payment schedules. So for example, our S&P ETF, we have a quarterly distribution on that one. Or maybe, for example, iShares pays semi-annually in that space. NASDAQ, because the yield's quite small, we pay an annual distribution. So you do get dividends. What you'll tend to find is more on dividend-paying ETFs, a monthly focus for that, because they're trying to provide a reoccurring revenue or recurring income for you there. But when it moves to like an S&P or NASDAQ, as the yields start falling, it's just more of the participation in the dividends across the board. So you do get to participate in. One quick note, if you're not seeing the dividends, you might have a dividend reinvestment plan on, so just check to see that. And frankly, if you want insights on the dividends, most ETF companies publish their dividends right on their website when they have been declared, because we publish that in the media, and we send out a press release saying, here's our dividends declared for the month or the quarter, and we'll list them all off across the board. Chris here, give us some background. I want to get some clarification why ETFs, why there are no ETFs of the major indexes that pay dividends. Maybe I just answer that, because you certainly are getting dividends. It might be an aspect of your account, maybe a feature in your account you've chosen, but there are dividends on your broad-based equity ETFs as well as your dividend-paying ETFs.
Yeah, and maybe you answered it very well. The frequency on the index tends to have a little lower income stream compared to kind of the dividend ETFs that we're talking about, or the covered call dividends that enhance the income even further. And the index pays a little lower, so the frequencies more spread out quarterly or annually. Certainly the ETF holder does participate from the benefit of the underlying dividends. So you think about, say, the NASDAQ 100, 100 companies, they don't always pay a lot of dividends, but they're actually paying more dividends. Every day Microsoft and Apple's now paying a dividend. So those dividends, when paid, are collected into the fund and reinvested in the fund on an ongoing basis. So yeah, there's no question the ETF holder always gets the benefit of those dividends, and then the fund, the ETF itself, will make a periodic distribution to unit holders depending on the fund. So certainly, the ETF holder benefits from the dividends that you're collecting on these underlying companies.
So good point there, Chris. Let's say, for example, just to answer the question on, some companies that pay dividends, what's that process again in the middle there? So let's say, for example, a company's paying a quarterly dividend and the ETF's only paying out semi-annually. What's that process in the middle there to make sure the investor participates?
Yeah, for sure. Why don't we use Canadian banks as an example? Pretty simple, and they're paying a really attractive dividend yield right now. ZEB is our ETF that holds 6 banks equally weighted, and I believe it's paying, Kevin, around a 4.7% dividend stream right now. So ZEB, the ETF, makes a monthly distribution payment. So that 4.7% gets broken down into 12 chunks, and we pay that out every month. Again, wanting to deliver that income stream for clients there. Underneath the hood, it's a pretty simple portfolio. As portfolios go, we hold 6 banks. We weight them back equally weighted twice a year. The banks in Canada, they all, I do believe, they pay a quarterly dividend. So inside the fund, we'll be investing cash, reinvesting cash. The bank will they'll pay quarterly dividends, so we'll get a kind of big chunks of cash will come in, we'll reinvest. We'll send a little bit out every month, but always whatever's coming into us in terms of those dividends from the underlying banks, we're going to send back out to clients. We'll just smooth it out, send it on a monthly basis. So that's what we do behind the scenes, manage the cash. But yeah, certainly, it's not as smooth an income stream as you see on the ETF, but those dividends are coming in, and we'll take care of the cash on the back end and make sure it's a smooth income stream. Hope that answers the question.
Thanks for that, Chris. And I know you personally work on that stuff because as a portfolio manager, you get that part of the job, right?
That's part of the
Chris,
job.
I think you actually tipped your hat to the part of the job. You tipped your hat to answer the next question, so let me just get to it. Question came in to ask, is there a low-cost ETF that encompasses all the major banks? Now, I think you tipped your hat to the Canadian one. Certainly can repeat that one. Is there more than that, too? I should also highlight. Maybe take it from there.
Yeah, definitely. So I think maybe I jumped the gun a little bit there, but I just think it's an interesting thing to highlight for investors. You don't often get the Canadian banks yielding close to 5%. So ZEB, I mentioned, just a simple low-cost ETF, holds 6 banks, and that's I think banks are. We know that we like investing in banks and they give us a good yield and dividend growth. Probably more important than just yield, Kevin, is the dividend growth and a growing dividend over time. Certainly banks have been known for that. We also have the ZWB, which takes that exact same strategy of the ZEB and applies a cover call overlay. And what you're doing there is you're selling in the option market, you're selling kind of a potential upside in return for current income. I always do like to recommend we just do that on a portion of the portfolio, and we're aiming to get you an extra 3 to 4% on average income through that process. And believe me, we do a lot of work on our PM side to manage that and make sure you're always growing with the market as well and participating. So yeah, those are the 2 big ones. And we highlighted US financials in the deck as well. There's actually some pretty decent yield in the US financials, so not what the question was asking, but maybe something to consider, have a small satellite position perhaps. The US banks are yielding about 4% as well right now, so lots of options out there.
Lots of options out there, and I'll quickly highlight that the ETF is equal weight too, so it's not dominant in any one particular stock too, so some key considerations out there. Now, that's all the time we're going to have for today. I'm going to say thank you so much for joining us. But with that, I'm going to say I encourage you to come join us next week, because next week we're going to do a special episode. We're going to take the time and effort and dive into the direct channels. That's the discount, the robos, and all the support you're seeing now being offered direct in this new work from home, plus the new world we're into. We've certainly seen a lot of growth in that area. We want to talk about the transformation going on in the marketplace, as well as we'll bring an ETF aspect into that too. We actually brought the president of Investorline on with us next week. Looking forward to having his participation, as well as Mark Graves from our product team to talk about ETFs in there. So look forward to you to join us next week, 1 o'clock, for our special episode where we dive into deep around the future of the direct channels right across the board. Thanks again for your time this week. Look forward to your questions next week, and please tell a friend about the webinar. We really appreciate your participation. Cheers.